Hello traders, welcome again. So today we are going to look at lesson number 2. Lesson number 2. Let's write these indicators. It's actually a session indicator. Okay, good. Now we're going to look at lesson number 2 today. And lesson number 2, we are going to talk about, I like to describe them as patterns. Let's use a better color, black. It's more visible. Patterns. So we're going to talk about patterns, and on patterns we have a lot to talk about. We are going to the most common pattern. I don't know if patterns is good for this as a topic for this part, but let's just call it patterns because I call them patterns. Number 1, we have the order blocks. Order blocks. So we have order blocks. Other people consider them as supply and demand areas. Are we together? Now we have a terminology for order blocks, and the terminology is always the OB. So if you hear any trader saying, I'm waiting for price to come into my OB, that means he's waiting for price to come into his order block. What are order blocks? Now, an order block is the zone identified as a place where institutional traders take the orders from before a push or a pull down. So it's basically a supply and demand area. Now, for example, this is where price was, and then it pushed up. So this one is considered as our order block. Why? Because this is where price pushed up from. So this is where the demand was from. Now, in trading, we always wait for price to come back to this demand area, and then price can continue upwards and then come back also to either this supply area. Now, I want you guys to see how price works, okay? Now, for example, we have this type of a trend. So it's a bullish trend because we have, as we were talking on our lesson number 1, we start with a low, a high, and then a higher low, a higher high, a higher low, a higher high. Now, we have different ways of getting into retracements in order for us to get an impulsive move. Just as I talked about yesterday about impulsive and retracements. This one being our impulse move, and this one being our retracement, and this one being our impulsive move, and this is our retracement. We would like to catch a trade before this impulsive move, or somewhere not around here but around here at the lowest point of the impulsive move. So we will look for an order block or a demand area for us to take the trade in order to get this impulsive move. Are we together? So that is how order blocks work. They are the ones that push price up or down. Now we have ways and criteria of looking into order blocks. Not every order block works, and sometimes not even the ones that reach to our criteria work. Okay, sometimes they fail. That's because of maybe price movement or other things affecting price. Now let's look at order blocks in a chart, because that is the only way we can look at them in the most simplest manner. Let's return the candles. Use the lower time frame. Maybe the 15 minutes is better. We are going to look into order blocks now. For example, we can see price is moving downward over here. Actually, now two types of order blocks. You have the bullish order block and the bearish order block. Okay, so for now we are going to identify both and see how price reacts to them. Number one, let's start with the bearish order blocks, because the market's already bearish. So as we said yesterday, when the market is dropping, we look for sales. Now the order blocks are the ones that are going to guide us in where to sell from. Are we together? For example, this market over here created a higher high and then a lower, that's a low, but this one is, yeah, this one is a low, it's better, and then now a lower high, a lower low, another lower high, another lower low, a lower high, lower low, lower high, lower low, lower high, lower low. Then over here we can see that price started now, it's not breaking, drop, creating another lower low, a high, and then another lower low, and then another lower high, a low, a high, another lower low. And that one will be now, it broke this one, so it becomes a high, a higher low, a higher high, and it continued that way. Now we are going to focus only on this area. Okay, now as we focus on this area, this is what happened. We had this area, this point where price came and tapped into. Okay, now as you can see, price bounced off this point over here, this one becoming now the supply area, the bearish order block. Are we together? Now this one becomes the bearish order block. Why? Because this is where price tapped into and dropped down impulsively. Now this is our impulse move, this is our retracement. Are we together? So this one becomes a bearish order block. Now we have a few order blocks still. Now order blocks are created, I think I always identify them as the last candle before an impulsive move. For example, like this one, that is an order block. Again, there's this one. This one's an order block. We have this one. This one was not tapped into, but it's still an order block. Okay. We have very many order blocks over here. Now, it must be the last candle before an impulsive move. For example, you see here we had these three candles bearish, yeah? But we do not have any impulsive one. So we come here, we get a bullish candle. Okay, after getting this bullish candle, we now have this bearish candle over here, which now makes price move impulsively to the downside. And this impulsive move breaks this low, giving us now this point will become our order block. Same as to here. This one here is also an order block. Okay, even though it's tapped into that order block, but this one is also an order block. Why is this an order block? Because now price broke impulsively this low. Are we together? So if you notice any candle after an impulsive move, there must be a reaction at it. Look at this one. If price comes back, then you can see there's a lot of, but at the end of the day they still broke. They still broke at it, and price continued up. Now this one over here is also an order block, but if you look carefully, there's no a large impulsive move over here, but we can see that price dropped into it impulsively and continued there downward. Now let's look at the opposite of it. There's this one over here. Price came, broke it impulsively, then went back again impulsively. Now when you see and look into these order blocks very keenly, we can realize that every time price comes into them, we can see there is a little rejection over here, but buyers were still strong and broke out of it. Now those are bearish candles, not candles, order blocks. Okay, this one was a bullish one. Sorry, this one was a bullish one, but let me remove it. But you can see every time price comes back to the order block, we see a drop. Over here we saw a little drop, then price still continued up, but you can see that price still broke these lows over here and this low over here after tapping into the order block. So order blocks are mostly pivoting areas for price. Okay, they are mostly pivoting areas for price. You can see this one. Now this one price came back to it impulsively, then price came back to it at the end of the day. So over here someone can consider taking a sell. Over here your stop loss should always be slightly above the order block, targeting these lows over here, because they are the most current lows you have to break. Now, those are bearish order blocks. Now, qualities of a good bearish order block is that it must have also a bearish fair value gap. What is a fair value gap? A fair value gap is that gap left in between three candles. Are we together? Now, the first candle and then the second candle must have a gap before it must have a gap, and then after it the next candle must close below it without filling its entire body. Are we together? The body should not be filled. A gap must be left in between. For example, if we look at most of the order blocks we've identified over here, apart from this one and this one that we began with, we can see that, like, this is a good example. We have a gap in between these three candles. Are we together? Now, we give breadcrumbs a fair value gap. Now, let's say this is our first candle color. Let me use a brighter color. Let's use like black or black. Yeah. So we have this candle over here, and then we have its wick. Okay. And then price opens another bearish candle, moving impulsively to the downside. Now we have a wick. So we have that wick over there. Then the next candle opens again and then moves again down. Now I want you to notice one thing. This next candle should not fill this body to the upside to this point here. So we are left with a gap in between that area. Are we together? So we see this gap over here left in between these three candles. Now this is the imbalance or the fair value gap. Are we together? So this one being the imbalance of the fair value gap, it must be entwined with the order block. For example, now let's clear this part. Let's come and look at our order blocks. Now let's start with this part over here. Okay, we have this order block, this bearish order block over here, and then we have a fair value gap in it here. You can see there's a gap there. So now this one becomes an imbalance or a fair value gap. Again, if we come back here, you can see now we have another fair value gap on it. Are we together? Every time we have an order block, there must be a fair value gap above it, below it or above it. No, mostly below it. Yeah, or above it for bullish market. Are we together? Now, these are two qualities of a good order block. An impulsive move which has created a fair value gap in between the order block and the third candle after the order block. Are we together? The third candle after the order block must have left an imbalance. So the second candle in between should have the imbalance, and then the order block should be above the fair value gap. That one is actually a very good block from, or take your sells or buys from. Now together, it is vice versa for the bullish market. Now let's look into a bullish market. I think gold had a bullish market. Let's look into gold. For instance, if you can see my order block over here, there is a fair value gap and there is an order block. So I will expect sales on gold from this point down here. Now for a bearish that's for a bearish order block. Now because the trend now changed and so I want to see price over here. There is also another order block over here. This one. So you used to come into it. There is also a fair value gap in it here. Now for gold, order blocks, I always prefer taking trades at the extreme order blocks after the ones that happened before the impulsive move. I prefer the extreme one. Now let's do bullish ones. For example, you have this one over here. It has a fair value gap over here. Fair value gap over here. So and we have our order block over here. Now if you see an order block in the higher time frame, it helps you to understand it more better in a lower time frame when you are refining your order blocks. But I prefer you first of all start by looking at your higher time frame bias before coming to lower time frames, in order for you to mark your order blocks on the higher time frame and refine them to the 15 minutes time frame. Now let's look here. Now price over here was going up until now price came to this zone. Price came to this zone. It was stopped here, and then now we have this area. I will mark these two because the bearish candle over here is the one that has the last low. So you can see now price came to that area. Now this one being our bullish order block, see that very clearly it had a fair value gap in it above it. Yeah, we had a fair value gap above it. Now that one being said, it now brings us to a point where we have to understand a certain concept called liquidity, where we have now inducements. Now inducements, they are more of how will I put them, fake outs. Yeah, they are more of fake outs which give traders early entries, and then later during the day or during the week the market will come back and liquidate the traders, or it will hit their stop losses. For example, this one over here is an inducement. Over here, this is an inducement. Why do I consider this as an inducement? I consider this as an inducement because one, price didn't make it to this order block in order for it to bounce back up. And also we can see price created this point of liquidity over here, giving buyers the opportunity to buy from this point going up. Now price has come back again, retested this area, but now you can see a lot of consolidation, but now price gave a fake out. You see this candle here, many people started buying gold at this point. Now it was a fake out. That's why you can see that I put up this yellow box, because it's also an inducement over here. Price now gives the fake out and then it drops massively, taking out the stop losses and then coming into this order block. Now over here, this order block is where institutions take their orders from and take buys towards the upside. I want you to notice and realize one thing. This type of pattern, when you meet this type of pattern where you have something like this, let me draw it for you. You have price going up, coming down, going up, then it comes to a point, goes up. Now you wait for price to come and sweep this point, then come to your order block, maybe somewhere here, and then you target the high. Now this one over here becomes your inducement level. You wait for your order block, maybe it's somewhere here, and you're there, close the order block, okay. So you take this one. This one is a very good pattern for an aggressive entry. If you're someone who has a problem of waiting for confirmations, this one is a very good pattern. For an aggressive entry. I hope until then we're together. Luckily enough, we will explain more on the order blocks and the fair value gap once we get to the fair value gap chapter. But today I wanted us to look at order blocks. Now we can see that now these are the demand area for price, and this is the supply area for price. I hope until there you understand how order blocks work and what order blocks are. Now have a good day.